Hey there, I'm Pete Townsend, and this is Money Never Sleeps. We look inside the minds of entrepreneurs and at the crossover of startups, enterprise, finance, technology, and life as we know it. In this episode, I'm joined by guest co-host Paul Smyth. Paul is a specialist executive recruiter and executive coach within the fintech industry, and as a founder of two startups, he's got a unique view on the startup ecosystem himself. Paul and I met back in 2017, shortly before I photobombed his stand at a fintech event in Dublin. We've collaborated quite a bit since then. He and his business partner and life partner, Laura Smyth from Top Tier Recruitment, were the original sponsors of Money Never Sleeps back in 2018. And since then, Paul has also launched a coaching business called Possible, and they count me as one of their proud customers. I was so happy with the outcome of Paul's coaching of me that I asked him to coach the founders that we bring through the Techstars Web3 Accelerator. As one of the many hats he wears, Paul is a fantastic coach in residence for Techstars, helping startup founders find their way to positive outcomes. In this Money Talk segment, Paul and I kick things off with a look at the recent State of European Tech 2023 report produced by Atomico, the non-traditional European venture capital firm. We then get into some of the key issues at play with a proposed digital euro and how central bank digital currency, or CBDC, adoption may be impacted by the context of privacy in personal financial transactions. This leads us to a rundown on SocGen's new stablecoin listed on the Bitstamp exchange, and we finish with a big question on what matters more in startup success: great founders or great markets? All right here on Money Never Sleeps. Paul Smyth, how are you?
Hey, Peace. I'm great. And yourself?
I'm good. I'm actually, as I mentioned a few minutes ago, I'm a little bit under the weather today, but you know, I haven't had anything like this in a year, so it's man flu. It's fine. I'll get over it.
Yeah. I had a month in Spain, so I really can't complain. My vitamin D levels are through the roof.
Yes, I can tell.
Pretty happy with life.
You're looking quite healthy there, young man.
Yeah, thank you. But everyone's saying, you know, you must say coming back to the weather. I actually love this weather in Ireland because, like, we're getting the house done, so we'll have nice triple glazed windows very shortly, hopefully, and we can turn on the heat and settle in, and those kind of crisp evenings and mornings. I just love it. I absolutely love it. Honestly,
I know.
I'm weird.
I was out bringing the kids to school this morning, and the crispness in the air just feels a bit like it's going to start snowing or something. And
it's like clean, and you can see further or something. I don't know what it is, but then Laura calls me Dorothy. You know, no place like home.
We got to get you some shiny red slippers, Paul.
only at the weekends, please.
Oh, I love it. You know, there's something to come back to there, and I will come back to on that. So one of the things that is creating some warmth out there in the world right now is a bit of an upswing in Bitcoin over the last couple of days.
Yes.
I think it's up 16% over the last, I think this week, 16% over the last week. And yes, FOMO, this is not investment advice. FOMO is kicking in, and you got to pile in a bit more. Obviously, you wish you piled in a bit more down at 20K, you know, but it is what it is. And, you know, there's so many projections out there for where this will go next year. And the theory that I'm poking around with, and I'm sure there are plenty others out there as well. So 2017, we were hitting 20K, and the floor of this bear market was around that point. Okay. Obviously, the ceiling of the bull market that followed the bear market of 2019, 2020, eventually, obviously, in 2021, and we hit 69,000. So will that be the floor of the bear market that will follow the bull market that we're about to go on? And the dates we're looking at here is that 2024, 2025, perhaps being a bull market, that if the floor of the following bear market in 2026, 2027 is expected to be the ceiling of the bull market, two bull markets back, then the floor will be 70K. Okay.
So you're saying pile money into Bitcoin right now. But
it's not investment advice. So the floor would be the floor of the following bear market in 2026, 27 will be 70K. So what does that mean for what the ceiling of this bull market will be? It's got to be at least 100K. I
Everyone
think
seems to be
that's a
saying 100 by
conservative
the end of
estimate. I'm
24.
talking myself into it. Again, this is not investment advice.
It seems different this time. Like, I think sometimes with crypto, there's a bit of confirmation bias and people are looking for signs that it's going somewhere north of wherever it is. And I think that's true in any market we've ever seen. But I think, and we'll probably cover some of this a little bit, I suppose, but the more institutional interest and activity that happens in that market, I think the more stability will come into that market as well.
Yep.
And the more solidity and the less volatility will be there. But I've kind of always said that.
Yeah.
And I guess it comes with, regulation and everything else and the advancements in that. But it'll be interesting to see what happens over the next while.
Yeah. Institutional interest is at an all-time high, it feels like right now.
Mm-hmm.
And just with the stuff that I'm reading every day and seeing more and more institutions, it feels like 2017 all over again.
Mm-hmm.
Definitely 2017 all over again. And then we had the same thing happen in 2020, 2021. And more institutions came in. And it's just that, with a bear market, it's more, a number pull out and all those projects get canceled. But then with the next bull market, they start to come back in. So, but I think zooming out a bit, that it is still a difficult market. It's still a difficult market for venture investment. And we had Atomico's State of European Tech 2023 report come out just in the last week or so. And that where the headline was out of CNBC that European tech funding halves to $45 billion back to pre-COVID levels, but AI is a bright spot. Duh, right? We're seeing tons of that. The way the numbers were is that total venture funding for European tech companies will reach $45 billion this year. Atomico expects, and that's down from $82 billion in 2022, which is itself down from $100 billion the previous year. And if that was 2021, I mean, that's when things were just going a bit crazy. You had all of these bigger, later stage venture funds that were coming back upstream to seed stage, and they were just writing huge checks. So I think all of that was obviously over inflated. But some encouraging signs there that, although it's been a difficult market, that we still have a decent level of investment. So climate tech stood out, and also AI. I mean, there were just, I think it was 11 mega rounds in AI.
Yeah. It was 11 of 36.
Yeah.
Over 100 million.
Yeah.
And there was a couple of big ones in there as well, wasn't there? Mistral and Alfalfa.
Yeah. Alfalfa.
They raised nearly $1 billion between them.
So much money is piling into the space right now.
And wasn't there something this morning about Elon Musk's XAI looking to raise about $1 billion as well? I think that was announced this morning. But it's, I don't know, like clearly there's something in AI. I just wonder, is there a little bit of a bubble around it? Because there's so much hype and so much interest.
Well, there is. And, now this is the Atomico report going back and looking at 2023, right? So fine. But we saw this happen just earlier this year. It's only been this year since, ChatGPT really entered into the lexicon of just everyday internet users, and people started to see this, and that the whole VC mentality of, hey, we need to be investing in things that see a decent uplift in valuation from seed to Series A to Series B and beyond, because that's how their returns work. And so if everybody's piling money in, valuations will go up, and boom, you have a bit of a bubble. But as early as, probably 3 months ago, kind of the joke going around was that, not even joke, but serious rhetoric of the VCs realized that big tech already have AI figured out. Microsoft with OpenAI, and we won't even get into that. That Amazon are doing something big. I think it's called Olympus. Twitter, X, as you mentioned, Elon Musk with their project. And there's a number of others for big techs. And that why should we be pouring a huge amount of funding into these smaller players that don't have the resources to compete with the likes of OpenAI and others? And that, let's move on. And so the VCs moved on, and there was a superconductor wave for a little while that lasted a couple of weeks. And then it's back to, okay, let's just cool the heads a bit and, come back to making some decent investments again.
Yeah. There was a couple of other pieces in that caught my eye. One was that even though it's halved, which is a big headline, it's still 18% higher than pre-COVID levels, and other regions are tending to be lower. One other thing I picked out was the growth stage funding has dropped significantly from US investors from 25% to 25% from 39%. And I think for me, it's like, what does growth actually mean now? I think growth before was funding loss-making ventures because they're adding new clients and getting numbers up all the time in the hope that eventually they turn positive from a revenue perspective. But I think COVID and everything that happened in the aftermath of that has redefined potentially what growth means. And there's probably an awful lot more scrutiny happening in terms of how do we actually make money? How do we make profit out of this business that we're funding? So that was an interesting one. And I think it's seen as well in valuations were lower, but the trend was more towards early stage where valuations are much more resilient. And there was a couple pointed out of valuations nearly halving in latter stages in terms of fundraising rounds, which is interesting as well. So seems to be investors are more comfortable making smaller bets on earlier stage companies rather than making larger bets on more mature companies that may or may not actually make it when it comes to it.
Yeah. Yeah. I there is a natural, and I've seen this, you see more risk aversion in European VCs than you do in the US.
Yeah.
And so there's that general perception, and that I hear this, and, I don't mean to label all of my VC friends in London tar them with the same brush, but the general rhetoric around London-based VCs is that they're closer to private equity, which is write bigger checks, take risks at a later stage. And that is kind of a commonplace perception. But I think that there's tons of innovation going on in Europe. And I think it is part of the just natural good fragmentation of Europe, in that you've got all of these. Yes, it is a 500 million strong person economy, but you've got Germany, you've got France, you've got Spain, you've got Italy, you've got Switzerland, you've got Austria, you've got Ireland, obviously Greece. Am I leaving anybody out? I don't think we need to name them all. People can look at a map, right? But each of these have universities. Each of these have a cultural shift of intelligence going into these university R&D type hotpots of activity with some wicked smart people, right? And it can be very fragmented in that instead of having everybody like in the US, well, everyone goes to Stanford, or everyone goes to MIT, or everyone goes to Northwestern, or that you've and everybody going through the same culture and the same way of learning and the same way of then moving forward with trying to get things funded, that you've got all these different ways of doing it across Europe. And so that naturally leads to a VC environment or venture investment environment that is a bit fragmented as well.
Yeah. But yeah, and it's different even from a product perspective. Like, it's harder to launch in multiple jurisdictions in Europe. I feel like even just language difficulties and cultural difficulties than it is to launch something that's, just US based. There's massive differences.
Yeah. The comment is that Europe must embrace risk more. And I think Europe does. It's just in smaller pockets of it that are centered around these hubs of activity, and that you don't see the bigger check writers at scale. You're seeing a lot of the smaller ones that are funding smaller projects.
Do you feel it's still a bit parochial? You get funded in the country you're in.
Yeah. And I was talking to a bunch of founders about this yesterday on a Techstars course that I was doing on building your investor pipeline, and that someone was asking me about, hey, with everything going on in the Middle East, if I am a company based in Egypt, am I afraid that I may not get VC funding from Egyptian VCs? And I said, well, it's the same problem in Ireland, and regardless of what's going on geopolitically, and that it's a small market. And so you're not going to have a wide breadth of VC diversity there across all the different stages. And so the risk mindset is focused into one VC. Are we going to do pre-seed, or are we going to do seed? Well, let's just do later seed. And, there may be some, and you won't find much in the way of pre-seed. In Egypt, I said to the person who asked me the question, I don't know anything about the Egyptian VC ecosystem, but I've got to expect that based upon the small size of the population compared to UK, Europe, US, that you're not going to have as much of a choice, which means you're not going to have as much of a diversity, which means that you're not going to have the specialists in those sectors for exactly what you're doing. So my advice is that when you're building an investor pipeline of 100 investors that you think may be interested in investing in your business, which is what you need to do, you need to look at 100. That if you're in Egypt and you're building a list of 100 investors, that list will quickly take you outside of Egypt. If you're in Ireland building a list of 100 investors, that list will quickly take you outside of Ireland because there's not 100 investors here. So I think that there is a parochial mindset that happens when another investor from outside of your region, outside of your country, is considering investing in you that says, who was a local investor that supported you? And they want to see that local investor support. And sometimes that's meaningful. Sometimes it's not as meaningful. The world has become more global in the 7-8 years that I've been doing this. So, but yes, in a roundabout way, Paul, I think there is some parochialness in VC investing in Europe. Absolutely. Still on the European tip, obviously, had a chat last week with my Santa Maria, and we packaged that up into an episode. And that came from a chat that she and I had a week before that or 2 weeks before that. And we caught up. And there was something that I was bouncing off of her. And there was an article that was in CoinDesk just last week on this fiery public hearing on digital euro sees experts diverge on key issues. The thought that I was having that I bounced off of was this. The obvious pushback on central bank digital currencies, that's what a digital euro would be. That's what we see as a digital yuan in China. And people are talking about the digital dollar in the US and the Bitcoin in the UK, right? And those are central bank digital currencies when they are living on a blockchain. Anything that is on a blockchain is a public register. You can go look and see what's in somebody's wallet. Now, you may not know whose wallet belongs to who because it's all anonymized with these long character codes. But if you had my wallet address, you could you could Google that. You could Google my wallet address and see what I have in my Ethereum wallet. Okay? So the starting point with everything on blockchain is that it's entirely public. And there are those that are working on things called zero knowledge proofs like Alio in the US, and where they decided we're building our own blockchain because we think that the zero knowledge proof technology that's out there isn't applicable to the way that we want it to operate. So instead of just building zero knowledge proof technology, which gives you some added privacy, we're going to build our own blockchain. So that context of, well, if you want a digital euro, then everybody knows each other's business, or could potentially know that, because if it is a digital euro, if it is on a public blockchain where the digital euro transactions live, then it is all, you can go onto Etherscan and find out what's going on, or whatever blockchain they use, whatever scan tool can be used for that. So my thought that I shared with was that, okay, what came first though in all of this? GDPR came first. Privacy regulation came first in Europe, where nobody can know each other's business. And so could you actually have a digital euro on a public blockchain where without these privacy controls? Because GDPR came first. And that was my question to and I don't know if we ever got an answer for that, because what ended up happening as well was that there was news on this kind of digital passport, this digital ID that the EU are bringing to market as well. And that you technically have this ability to link somebody's ID to a transaction. That is just a hot pot of anti-privacy. And we need to do something about that. So I kind of came out of that conversation a little bit more optimistic about a central bank digital currency in Europe, because my original, and not everybody, but those looking at the space have said that totally eliminates privacy. But in a land of GDPR, I don't think you could have a digital euro construct where it is anything but private.
It sounds like you're building a case for it to be on a private blockchain.
No. It's that I haven't connected all the dots yet. But when I spoke with Alex Pruden, the CEO of Alio last year, he said, listen, where you're starting with on blockchain, if we back in 2015, 2016, when I first got into this space, there was so much excitement at the financial market CEO level about blockchain and about the ability to tokenize assets, tokenize securities, and move the entire financial markets onto a blockchain. And that that quickly ran out of steam because people realized how hard that was going to be. And Alex's point was, yeah, great, you want to do that, but the way that blockchains work today is that you don't, unless you implement a private blockchain for this stuff, which they may still do, if it's all on a public blockchain, which is the most efficient way to run a blockchain, then it's all out in the open. It is all out in the public. Okay. And that just doesn't fit with the general populace's mindset towards privacy. So Alex Pruden said, listen, this is why we're building their own layer 1 blockchain, because there is a thing called zero knowledge proofs, and I won't get into what those are and how they work, but that will, like I said a few minutes ago, will add an element of privacy to blockchains. And if we end up in a situation where CBDCs are launched on private blockchains, then the government has all your information anyway, which is not what we wanted. And that is perhaps why the Chinese yuan was the first central bank digital currency to come to market, because in China, the government knows your business anyway, right?
Yeah. Blockchain Ireland this year, I was having a chat with someone, and it was all about, CBDC and would you use it, would you not? And sometimes I kind of have this thing about people in this crypto space asking people in the crypto space, would you do things with crypto? And it's kind of like you're asking the wrong people. To me, if it's easy to use and it's straightforward to use and everything else, I kind of think the population in general
don't care.
Kind of don't care. Yeah.
They don't care.
If I can go
generally
and buy what I want to buy
they don't.
in the shop with tap on my phone, I don't really care what happens.
I don't care if the government knows.
Yeah.
And that's just it. The majority do not. I think, though, as this becomes more and more of the norm, that the ability for surveillance at a macro level by the government of what everybody's doing, that will eventually become a concern.
Totally. I think the bit that stood out to me in that was, so if you have this central bank centralized currency, what happens to the commercial banks?
Well, that's the point. So I was working on a project with a company called Billin a couple of years ago on this, and where there's two models of central bank digital currency. One, the central bank itself is the issuer, and then they take on a responsibility at the retail level. So imagine the Fed handling disputes between you and the shopkeeper, where this actually happened to me a couple of weeks ago, or back in May, and it took this long to sort out, where I bought a round of drinks that was €14.70, and what ended up on my card was €147.30. Okay, so someone miskeyed it.
I won't ask where you bought the drinks either, Pete.
What?
I won't ask where you bought the drinks.
It was at the Glenview Hotel at my daughter's confirmation. Okay, so it was all on the up and up. But listen, so it took 6 months for me to get that back, and they had to write a check for me to get that money back because no one could figure out what happened.
Yeah.
I filed a claim with my bank. They reversed the charge. 45 days later, they reversed the reversal, all this other stuff. Does the central bank really want to deal with that kind of stuff? Where there's a transaction that they are the only, not even party to the transaction, but they're the issuer of that currency. They are owning and operating the blockchain on which this transaction happened.
Yeah.
Do they want to own? No, they do not.
Yeah.
So Billin proposed, let's go back to what we did in the 1800s, which is that commercial banks issue notes, but they issue them in a fungible way so that JP Morgan's issuance, Citi's issuance, SocGen's issuance, whomever's are all fungible. And people know that, like, yes, when you have a euro note, that you look at the back and you can see that euro note was printed in Greece. Doesn't matter. I could still go into a shop in Ireland and, buy something with that note. And it's the same way as that you'll know that the euro or the dollar in your digital wallet was issued by JP Morgan, but it's acceptable everywhere because it is fungible across the different issuers. And that let those commercial banks then deal with the disputes. Okay. And they license the technology. Who cares about the contractual arrangement? But, operationally, they license the technology in order to issue digital currency. and that just let them do it, because they're the ones who are creating money right now through the loan process. So let them keep doing that. And I think that's the way that this will go. But, I think we're going to see the central banks as a pilot project. They will be the ones who are issuing the CBDC.
Who do you think is going to get there first? Nigeria
is already there, right? There's already a lot happening there with the e-Naira. China's there, but it's you are inserting a new form of payment into an economy, and these things take a while, right? How long? Like, I still go over to the US and I try to tap something, and they're like, "Oh no, that doesn't work here," So it's gonna take a long time, and I think it's gonna be it'll be a bit watered down by the time it gets to the point of mass adoption, and that like you said a few minutes ago, the majority of the populace do not care. If I go buy an apple in a shop, I don't care who knows that I bought an apple in a shop.
Yep.
But there will be other bigger transactions that people don't want anybody to know about, and those aren't things that are illegal. Those are things that perhaps where, I've got a friend today who has a small business and bought a nice piece of artwork for the wall in his home office. And he bought that on the business because it was art for the business. And obviously he bought that pre-tax. Okay. So do you want things like that to be on a governmental record? Probably not. So.
Yeah. Still a bit to work through.
There is. But there was something that happened that was just announced this morning that I missed that you picked up on.
Yes.
Which was SocGen and their stablecoin.
Yes.
Tell me about what happened there.
First big bank to list a stablecoin. So there's some kind of key differences in this, because banks have done stablecoins previously, but they're calling it convertible, and it's trading on a Luxembourg exchange called Bitstamp. And it was going to be offered just to institutional clients to bridge that gap between traditional capital markets and digital markets. So similar enough to what JP Morgan and others have done, but it was on Ethereum rather than on a private blockchain. But then this morning, it was announced that it was going to be traded on Bitstamp on the exchange. So key difference there. And I think what I was wondering with this, or what caught my attention with this, apart from the headline, was with the likes of kind of Tether and Circle both facing questions about reserves actually backing tokens. Does the likes of a SocGen, well-regulated financial institution, offering what they say is going to be a fully backed token on an exchange, nudge things forward a hell of a lot? Their CEO of SocGen Forge, the crypto side of SocGen, was also quoted as saying it's been built to align with MiCA rules. So kind of forward looking in the not too distant future. Like a lot of noise around this. UK regulators giving the green light to tokenize funds as long as they maintain what they're calling mainstream assets. Other regulators making strides, particularly in Asia, around regulating stablecoins and tokenization. It just feels like, as we kind of said at the top, or maybe before we started, that wave of institutional interest and adoption in the whole space is getting stronger and stronger. And will that scrutiny and regulatory robustness drive people towards more mainstream adoption of crypto, blockchain, tokenization, that whole world?
Yeah. I mean, like I said, I reviewed easily, I don't know, 150, 200 deals in the last week coming in, and I saw so much where I'm like, all right, stop using the word Web3, stop using the word blockchain, stop using the word crypto, just eliminate it from your deck because you don't need it. This is a consumer app. And so much of this that we're talking about right now is that, okay, folks, it's just a new form of spending money. Stablecoins, though, you're right. Stablecoins to me are a bit of a bridge to adoption and to giving consumers something that is easy for them to understand. It's a digital token that is backed by dollars or euro or any other currency. And that when you have the things like the EMI licensing and registration process in Europe, the electronic money institution, we have that here. And that's already kind of the bridge for crypto exchanges to do this, is that crypto exchanges themselves in Europe, if they're going to accept fiat currency, to be able to enable customers to convert that into crypto, that they need to be an electronic money institution, because they need to be able to hold that on reserve on a one-for-one basis in a safeguarding account that is only for client funds. And it needs to be totally segregated, right? And any crypto exchange in Europe needs to operate that way. Okay. And what is, in effect, a stablecoin issuer? They are an e-money institution because they are accepting fiat and they are then issuing in return, they're issuing a digital representation of that.
Yeah.
Now, because in the US with Circle, and I think Tether is offshore, there is no EMI licensing regime. There are different ones like money transmitter license and that type of thing, which are not anywhere near as robust as EMI in Europe, that they've been able to be these issuers with, okay, only 90% backed, because 10% of that is backed by treasuries, by other, corporate notes, corporate paper, whatever. And what's happening with Mika is that if you are issuing a stable coin, you need a Mika license and you need 100% backing. So that's going to take away the profit opportunity, because that's how Circle and Tether make money, is that it's only 90, 80, 60% backed. Who knows in Tether's case, but it feels like where things have gone is more towards 80, 85, 90% backed, and the rest they invest and they make a profit off of that, and that's how they make their money. And so it's kind of almost like quasi banking. But I see stable coins event, at least in Europe. SocGen, with this one that they've launched, are following Mika, then they're doing it with 100% backing. And so for them, it's just, okay, we're going to take deposits, and instead of loaning out 90% of that deposit, we're going to make it available as a stablecoin.
It was mentioned in the article as 1-to-1.
So they are holding that on reserve. So they are taking deposits, and contrary to the way banking works, they're not loaning out a penny of that. In ordinary banking, for every €100 that you deposit, your bank is turning around and lending out 90% of that and creating more money and making money off of that. So I think this, while I'm impressed that SocGen are doing this, I don't think it's scalable, because how are you going to make money?
It's like a light version almost of not a CBDC, but it's a 1-to-1 backed digital asset.
It's a nice experiment.
And when you think about adoption and mass adoption going forward, I think it's interesting. And, even at the start of this, what we were talking about in terms of where Bitcoin is going, like the whole CZ and Binance saga over the past while hasn't put a dent in anything in terms of where the price of crypto has gone. Very different to what happened, this time last year, I think it was, with FTX and everything else. So it's really, really interesting. Obviously a big impact for Binance since then. I think their share of the spot crypto market's gone from 50% or above 50% to 32% this month. And the same in the derivatives market. But it just feels a lot more like robust. It feels a lot less jittery than it was previously.
It does. And yes, institutions are coming back. The momentum that started in 2015, 2016 with real world assets and tokenizing real world assets. And that is such a huge topic right now.
Yes.
And we're seeing so many banks that are running pilots in that space. And it's like they're finally getting up the curve with this technology. And that's how long it takes banks to get up to speed with new technologies. That's why they're banks, and that they do things slowly, because they have to. If you are actually running a business model where for every $100 that you take in, you're loaning out $90, you better be running a pretty safe operation in order to make that all work and to keep track of all that. So don't introduce new technology. And if you have a side unit that's doing some investment and messing around with some proprietary trading, okay, go ahead, do that. But that's going to be smaller scale, and you don't want to mess with this model, the traditional banking model. So I think, longer term, I don't know what's going to happen with the traditional banking model, but we're, 20, 30, 50 years off from that.
Yeah. Interesting to see where it all goes anyway.
Absolutely. Is there one more thing? There was actually a question I wanted to ask you.
Okay.
So there is a Substack. There's a newsletter called The Generalist. Mario Gabrielli. Have you ever read this?
No.
I was flipping through it yesterday. And the question that was posed, and in the context of kind of like what we've been talking about, scaling new products, scaling new businesses, and growing them. and producing venture style returns and enabling things to be carried forward so that private equity can invest in
Mm.
them. And this whole cycle that happens from early drip of the stage of the entrepreneur's mental
Yeah.
psyche off of the glacier that is their brain when they're working in a corporate environment or perhaps still in university, and they start to get into the flow of the entrepreneurial spirit.
Mm.
What does it take to succeed? And Mark Andreessen back in 2007 said that it's a great market. Great markets rule all. And that you can have a mediocre founder in a great market
Yeah.
that actually grows an incredible business,
Mm.
rather than having an incredibly brilliant founder in a mediocre market. That Mark Andreessen would always vote for the great market with a mediocre founder over a great founder in a mediocre market. You've grown your business
Mm.
with Laura, and you've fought through mediocre markets. What do you think rules out here? A great founder mindset or a great market?
I think for me, I'd back a founder more than a market. Longer term, I think you should, like short term, if you're in a good market, you're in a good market. Like if I think about housing in Ireland, if you're an estate agent over the past few years, you don't really have to do a whole lot. You post your ad on Daft or My Home or whatever, you sell it. It goes whatever, 10, 20, 30% above market. So really easy in a market like that to make money. And it's similar in recruitment. But I think longer term, you need good founders to really thrive in down markets and in good markets. Like I've always thought athletes and football players and stuff like that. Like if you think of Cristiano Ronaldo, David Beckham, everyone would say, Ronaldo is not, or say Ronaldo and Messi might maybe a better example. Ronaldo is not naturally as talented as Messi, but he works really, really hard. So he's your really good founder, for example. Messi's more naturally talented, probably doesn't have to work as hard. Both end up kind of up there and up there. So it's not going to be, people don't see where I'm pointing. I'm pointing really high, in
Yes.
terms of the level that they get to. So I think that's a combination of kind of what we're talking about. If you have a really good founder who's naturally good and gifted and works really hard, they'll do better in a down market, but they'll also do better in an up market. If you have a mediocre founder, they'll do well. If you're investing in them and you get out early, you'll make money off them for sure. But when things start to turn, the cracks will start to appear.
Yeah. Yeah. I know. And I'm just always on the quest for the fantastic founders.
I like it's got to be. Do you know what? Actually, it's not just founder. It's got to be team.
Yeah.
It's got to be team. There's not too many solo founders out there. And I think that team piece is just so important. And it gets really hard because the pressure is insane. And people want to go in different directions, and, accountability and communication and all of those sort of soft skills come into really sharp focus, I think, as you start to go through the tough times. So someone who can work within that team, but is almost that natural leader of that team as well.
Yeah.
Uh,
That's where I'm going. Like, does that single, because when I came into the space back in,
Yeah.
2016, my first, big eye-opening experience was that not all startup founders are fantastically wonderful, charismatic leaders.
no, not at all.
Very few of them are. Very few people are in the world.
Yeah.
And so one great founder build a fantastic team and have the emotional intelligence to be able to keep people moving through thick and thin, through the ups and downs, the great markets, the mediocre markets. And that, yes, it takes a team, but is it still that one amazing founder?
Yeah, like one of the other things that I would see as a commonality amongst great founders is the ability to know when they need to bring in help, and to be able to let go a little bit, to be able to identify your own blind spots and be honest with yourself about, I'm good at this, I'm not as good as that, and I can get the business to a certain level, but I can't go beyond it. I need to bring in external help, whether that's a new CEO and you step into a chair position, or a head of a different function, or you stay in your lane that you're really, really good at. But that's so difficult. Like that's so difficult for founders.
Oh, yeah.
And I'd see it on the recruitment side in particular. I know a couple of hires that we've made externally for clients in that, I don't know, early growth stage, they haven't worked out. And the commonality has been Not that they've hired people who couldn't work in a startup, but because the founder couldn't let go of the thing that they've been doing for 3 or 4 years before. That's a big thing as well.
I know. And I mean, team, yes, critically important. Earliest stages. You can't do this yourself. It's very, very hard to do this yourself. One person can bring in a dev team to build their vision for them, but you just need that help. You need that technical co-founder. And Alan Meany said this to me years ago. You need that technical co-founder. So on the day that you're going live, that at 3 a.m, before that go live day, everything falls over. You need someone who's incentivized, that really wants to get that back up and running at 3 a.m. on a Sunday night. Okay. So team, absolutely. And I invest in fantastic teams. That's my mandate. That's what I do. And fantastic founding teams. But I do think when you're looking at this in comparison to, is it great market, great founder? And by saying great founder, do you mean great founding team, or single charismatic leader that can bring things through every round to a public offering, to a direct listing, whatever it is? Those are very few and far between.
Yeah.
And so for the nature of the amount of amazing companies that have scaled and that have made it out into the public markets and generating billions and billions of wealth, that I think that is a lot less dependent on incredible single great founder, because there just aren't that many people out there. If you look at all the success stories of all the best companies that have made it from the very beginnings of the entrepreneurial journey all the way to the public markets, I don't think you're going to see a huge, it's very imbalanced. Thousands of companies, probably hundreds of incredible founders. So that then leads me back to, is it the market?
I still don't think so.
No.
I think the assumption there is that you have one founder who is at the helm of that company all the way through its trajectory to becoming a massive, company. Whereas I think it's more important that you have a founder who can step back and fill the gaps that they obviously can't do themselves. They don't need to be that charismatic person who can go and close rounds with everyone. Like, I think in early stage, it's more important because there's less of you. Someone has to do it. And you got to find the person in the room who can be that person, who can stand in front of investors, convince them to part with money in a tight market like this in particular, and put a bit of a bet on you. But you don't need to be the same person when you're going Series A, Series B, Series, it doesn't have to be that. It's much more about the team then. So how do you identify the team that you need? Like, it's like a lot of it's self-awareness and getting out of your own way a little bit, and just not being so caught up in, I'm the CEO, I have to do all of these things or else I'm a failure, because you're not.
You're right. It's even like I'm thinking of one company where the incredibly focused and talented and incredible negotiator that is the CFO.
Yeah.
And that the CEO could not live without that individual. Impossible.
100%.
And that is something that when you can get that pairing at the earliest stage, that's wonderful. But going through your life cycle, there will be people that come in along the journey. So I think we're back to the question of great market, great founder, great market versus great founder. I think the answer is somewhere in between.
It depends what you're looking for. I really think it depends what you're looking for. If you're looking for longevity, it's got to be about founder and team and what that's going to look like long term. Because in a down market, that's when the cracks appear.
But it's not one single founder.
Or founder / team, whatever you want to call it. Or leader of team.
But it's not one single individual that is the initial first founding CEO.
Yeah.
That is responsible for a company's success. It is the team at the earliest stages. It is, how are you responding to the market in up and down times?
Yeah.
And what are the people that you can bring in along the way to the journey, to achieve the vision with you? And the markets will go up, the markets will go down, the markets will go up, and the markets will go down. So I think the question that I asked originally is flawed, right? Because I think posing, is it the market versus, so going back to the generalist and Mario Gabrielli, and the whole point of having this chat was me thinking, Mark Andreessen, are you right by saying it's the market? So forget about the person who's driving the bus. and the team of people that are helping them to navigate. And he's saying it's the market. He's like, in any great market, a mediocre founder can make it. I think what we're saying here is that regardless of what the market does, there is no path to success anyway without a great team.
I disagree slightly with that as well, because I started in recruitment in 2007, September 2007. So I literally had 12 months of financial services recruitment in Dublin before Lehman Brothers crashed in 2008, September 2008. And back then, Merrill Lynch were my big client, and they were paying what would be considered a very good fee and paying very good salaries, even in today's market, for graduates. All I had to do was find people who had a finance degree and who could put a sentence together. I'd send them out to Sandyford, they do an interview, they get an offer the next day. I could make money in that market with zero training, like literally zero training. So I didn't need to be a great recruiter. I don't claim to be a great recruiter now. Pretty good, I think, after 20 years. But like, my point is, I didn't have to be great at anything at all. I could just place people because the market was like that. The same with estate agents selling houses the last 3 or 4 years in Ireland. Like, it's easy. You post an ad and it's done. So yeah, like, the market's important. I think you'll make money in a good market off a mediocre team and a mediocre founder, because a rising market will lift all ships. But for anything kind of longer term, or if you're going through any turbulence, I think it's much more important to focus on the founder, the founding team. And especially like in early stage companies, everyone loves a good pivot, so you're in a great market. All of a sudden, the market doesn't necessarily want what you think it wants. You got to pivot. I want someone who's going to be able to lead that rather than, you know what I mean?
Yeah. And I think I just nailed what it is that Mark Andreessen was saying, is that he's thinking like a VC. And when he said this back in 2007, 2008, he wasn't a VC yet, but it's that VCs think in cycles, in
Absolutely.
3 to 5 year cycles of, if you can time it right and you get your fund launched at the point in time, you start deploying that capital where valuations are on the uptick because it's a great market, then you're going to be able to return capital to investors within 3 to 5 years. And you've benefited significantly from the great market, even though you've got a bunch of mediocre founders. But if you're looking at this for long-term, 10, 15, 20-year investing, you need a team of fantastic founders.
Warren Buffett versus VCs, it's a different mentality, a different way of looking at it. But surely that's why there was so much money poured into AI, because it's a good market. You invest, 10 million into 10 different AI firms. There's a reasonable chance that a couple of them are going to do okay and you're going to make your money back.
You're right. Well, listen, my challenge that I had of myself that I didn't share with you was to see how cerebral that Paul Smyth could get on this topic without sharing it with you before we went on air. And I think that with everything that you do, Paul, that you are quite cerebral. So anything that I put in front of you, you could sound quite cerebral. So thank you.
I can come up with an answer anyway.
Yes, you can. You can. So listen, thank you. This has been a wonderful chat. I'm glad that we got to do this today.
Yeah.
And I know I'll be seeing you in the next couple of weeks.
Looking forward to it. Thanks, Peace.
Thank you. That does it for this week, folks. You can learn more about the stories we covered in the show notes on our website, moneyneversleeps.ie. Thanks to Paul Smyth for all the insights he shared in co-hosting this episode with me. We'll do a deeper dive into the output of this conversation in our Money Never Sleeps newsletter on Substack. So check that out on moneyneversleeps.substack.com and subscribe. If you like what you heard, please leave us a rating and a review on Apple Podcasts or Spotify, as it helps others to find the show. Also, thanks to Conan Brophy from Create Sound for mixing and editing this episode. Conan is an excellent media man to get in touch with when you're thinking about launching your own podcast. As for me, I'm an early-stage startup investor focused on where fintech meets crypto and crypto meets Web3, and I lead the Techstars Web3 Accelerator. There are plenty of links in the show notes on moneyneversleeps.ie on how to get in touch, so don't hesitate to reach out. Finally, till next time, thanks for listening. See ya!
Money never sleeps, pal.